There's this moment in history most people have never heard of, and it involves a chess match that nearly collapsed an empire. Stay with me here, because what happened in 1842 is about to explain what Japan just did last week, and why your portfolio might be in serious trouble, whether you realize it or not. My name's David, and I spend way too much time thinking about central bank policy and currency manipulation. If you're someone who's tired of hearing the same recycled financial advice that never actually builds wealth, and you want to understand what's really happening behind the curtain so you can position yourself correctly, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact mechanism that central banks use to manipulate entire economies. And more importantly, how Japan just triggered a chain reaction that's going to affect every single dollar you have invested, every retirement account, every savings vehicle you're counting on. This isn't theory, this is math, psychology, and historical pattern recognition, all pointing to the same conclusion. So let me take you back to 1842, to a chess game in St. Petersburg that almost nobody remembers. The Russian Empire was obsessed with chess, not just as a game, but as a symbol of intellectual dominance. The Tsar wanted to prove Russian superiority, so he arranged a match between the best Russian player and a German master named Ludwig Bledow. Here's what made this interesting. The Russian government didn't just sponsor the match, they bet on it heavily. They issued bonds, essentially IOUs, backed by the assumption that their champion would win. Foreign investors, seeing Russia's confidence, bought these bonds thinking they were safe. The interest rates were attractive, maybe 6 or 7%, and everyone assumed Russia wouldn't stake its reputation on something uncertain. But here's the thing about confidence. It's only worth something until it isn't. The German player didn't just win. He dominated. Game after game, the Russian champion fell apart. And suddenly, those bonds that seemed so safe, they were backed by nothing but embarrassment and national pride. Investors panicked. They tried to sell. But who wants to buy a bond backed by a losing chess game? The price collapsed. People lost fortunes not because the underlying Russian economy had changed, but because the perception of invincibility had shattered. Now, you might be thinking, what does a chess match from nearly 200 years ago have to do with Japan's monetary policy in 2025? Everything. Because what Russia did with chess, Japan has been doing with interest rates and currency manipulation for decades. And last week, they just lost their chess match. Let me explain what actually happened, because the headlines aren't telling you the real story. On the surface, the Bank of Japan raised interest rates by a tiny amount. We're talking about a quarter point, from around 0.1% to maybe 0.35%. Most people saw that news and shrugged. It sounds technical, boring, irrelevant to daily life. But here's what they're not telling you. Japan has been playing a very specific game for the last 15 years, and that tiny rate hike just flipped the entire board. Here's how the game worked. Since around 2008, Japan has kept interest rates at essentially zero, sometimes even negative, meaning you'd pay the bank to hold your money. Why would they do this? The official reason was to stimulate their economy, encourage borrowing, get money flowing. But here's what actually happened. With rates at zero in Japan, investors and hedge funds and even regular wealthy individuals could borrow yen for almost nothing, convert that yen into dollars or euros or any currency with higher interest rates, and invest in those markets. This is called the carry trade, and it became one of the most popular strategies in global finance. Think about the math for a second. You borrow 10 million yen at 0.1% interest. You convert it to dollars, let's say around $75,000 depending on the exchange rate. You invest that in US Treasury bonds paying 4%, or stocks returning 8 to 10% annually. You're making money on the spread between what you're paying in Japan, almost nothing, and what you're earning elsewhere, something substantial. As long as the yen stays weak or stable against the dollar, you pocket the difference. Now, here's where it gets really interesting. This wasn't just a few hedge funds doing this. We're talking trillions of dollars, literally trillions, flowing out of Japan into global markets because of this interest rate gap. And all that money had to go somewhere. It went into US stocks, it went into real estate, it went into corporate bonds, emerging markets, crypto during the bull runs, everywhere that promised returns higher than zero. But now you're asking yourself, what happens when Japan raises rates? Even a little bit, the whole mechanism reverses. Suddenly, borrowing yen isn't free anymore. Maybe it's still cheap, but it's not free. And that tiny difference changes the entire calculation. If you're paying 0.35% to borrow yen instead of 0.1%, and the yen starts strengthening against the dollar because higher rates make it more attractive, your trade goes from profitable to break even to losing money fast. So what do? You unwind. You sell your US stocks, your bonds, your real estate investments, whatever you bought with borrowed yen. You convert those dollars back to yen to pay off your loans before the exchange rate moves against you even more. And you do it quickly. Because if everyone else is doing the same thing at the same time, asset prices are going to drop and the yen is going to strengthen and your losses are going to multiply. This is exactly what started happening last week. The Nikkei, Japan's stock index, dropped over 4,000 points in 3 days. That's not a correction. That's panic. The yen strengthened against the dollar faster than it had in years. And US markets, they started wobbling. Tech stocks got hit especially hard. Why? Because tech stocks have been one of the biggest beneficiaries of all this cheap Japanese money flowing into global markets. Now, let me take you back to another historical moment, because this pattern isn't new. Let me tell you about Mexico in 1982. And I promise this connects directly. Mexico in the 70s was booming. They discovered massive oil reserves. The government borrowed billions of dollars from American and European banks to build infrastructure, refineries, cities. The logic seemed sound. Oil prices were high, hovering around $35 to $40 a barrel. Mexico could pump oil, sell it, use the revenue to pay back the loans, and everyone would profit. Banks loved this deal. They lent money hand over fist. By 1982, Mexico owed around $90 billion to foreign creditors. But here's what nobody factored in properly. Those loans were denominated in US dollars, not pesos, and the interest rates were variable, tied to what the Federal Reserve was doing. In 1979, Paul Volcker became chairman of the Fed and decided to crush inflation by raising interest rates aggressively. Rates went from around 10% to over 20% in some cases. Suddenly, Mexico's debt payments exploded. At the same time, oil prices started falling. Revenue dropped while costs skyrocketed. In August of 1982, Mexico announced it couldn't make its debt payments. Just like that, the Mexican finance minister flew to Washington and essentially said, "We're out of money, we need help." Within 48 hours, $87 billion in loans across Latin America were suddenly at risk because if Mexico could default, so could Brazil, Argentina, Venezuela, everyone who'd borrowed in the same way. The banks that had lent this money, giants like Citibank and Bank of America, faced catastrophic losses. Some of them had lent more money to Mexico than their entire capital reserves. If Mexico didn't pay, these banks would be insolvent. Not struggling, insolvent. The US government and the International Monetary Fund had to step in with emergency bailouts and restructuring plans that took a decade to sort out. Who won in that scenario? The banks eventually got bailed out, took some losses, but survived. The consultants and lawyers who restructured the debt made fortunes. Who lost? The Mexican people, who endured a decade called La Década Perdida, the lost decade, with crushing unemployment, inflation over 100% at times, and poverty that erased a generation of progress. And here's the kicker. The banks that caused the problem by overlending walked away damaged but intact, while the borrowers suffered for years. So what does this have to do with Japan right now? Everything. Because Japan's strategy for the last 15 years has created the same kind of dependency and vulnerability that Mexico had in the early 80s. Except this time, it's not one country that borrowed too much. It's the entire global financial system that's become addicted to cheap Japanese money. Think about it this way. When Mexico borrowed in dollars and oil prices fell while interest rates rose, the math stopped working. When Japan kept rates at zero and everyone borrowed yen to invest globally, the math worked beautifully as long as nothing changed. But the second Japan raises rates and the yen strengthens, the math breaks. And unlike Mexico, which was a regional crisis, Japan's carry trade unwind affects every major market on the planet because that money is everywhere. Now, let me give you an analogy that makes this crystal clear, something you can picture happening in your own life. Imagine you own a car worth $30,000, paid off, no loans. You feel pretty good about that. Then someone offers you a deal. They'll lend you $50,000 at 1% interest per year, $500. You think, okay, I can take that $50,000, invest it in an index fund that historically returns 8 to 10% annually, and I'll make $4,000 to $5,000 a year while only paying $500 in interest. That's a $4,000 profit annually just for borrowing and investing. Sounds smart, right? So you do it. Year one, the market goes up 9%. You make $4,500 on your $50,000 investment, pay $500 in interest, pocket $4,000. You feel like a genius. Year two, same thing. You're making money while you sleep. You start thinking, why don't I borrow more? So you borrow another $50,000 at the same rate. Now you've got $100,000 invested, making $8,000 to $9,000 a year, paying $1,000 in interest, netting $7,000 to $8,000 in profit. But then something changes. The lender raises the interest rate from 1% to 3%. Now you're paying $3,000 a year instead of $1,000. Your profit margin just shrank. But okay, you're still making money if the market cooperates. Then the market drops 20% in a month. Your $100,000 investment is now worth $80,000. You're sitting on a $20,000 loss. You still owe the full $100,000 in loans. Plus now, you're paying $3,000 a year in interest on money that's actively losing value. You panic. You think, I need to get out before this gets worse. So you sell your investments at $80,000, lock in the $20,000 loss, and use that money to pay down part of your loan. But you still owe $20,000 that you don't have. You have to sell your car, the one you owned, free and clear, to cover the remaining debt. Now you've lost your car, you're down $20,000 from where you started, and all because you borrowed cheap money assuming nothing would change. That's the carry trade. That's what's unwinding right now. Except instead of one person with a car, it's institutional investors with trillions of dollars. And instead of selling a car, they're selling stocks, bonds, real estate, anything they can liquidate fast. And here's where the villain of this story comes into focus. It's not just Japan. It's not even just the hedge funds doing the carry trade. The real antagonist here is the central banking system itself and the way it's created a global economy that's completely dependent on artificial interest rates and money printing. Let me explain their motive, because once you see it, you can't unsee it. Central banks, the Federal Reserve, the Bank of Japan, the European Central Bank, all of them have one primary goal that they'll never say out loud. It's not price stability. It's not full employment, though they'll claim that. It's preserving the financial system as it currently exists, which means protecting banks, protecting governments' ability to borrow cheaply, and preventing any kind of deflationary collapse that would expose how much debt is really in the system. Since 2008, central banks have kept interest rates artificially low, printed trillions in new currency, bought government bonds, and corporate debt to keep markets inflated. Why? Because the alternative is admitting that the debt levels, government debt, corporate debt, household debt, are unsustainable. If interest rates went to their natural level, whatever the market would set without intervention, governments couldn't afford their interest payments. Corporations that have been borrowing cheaply to buy back their own stock would face bankruptcy. Housing markets would collapse because mortgages would become unaffordable. So central banks chose inflation and asset bubbles over deflationary truth. They made borrowing so cheap that everyone, individuals, companies, governments, borrowed as much as possible. And Japan was the extreme version of this. Zero rates for 15 years. Negative rates at times. The Bank of Japan literally bought stocks to prop up their market. They own over 6% of the entire Japanese stock market through ETFs. Think about that. The central bank is one of the biggest stock investors in the country. That's not a market. That's a managed economy masquerading as capitalism. Now here's how they hide it. They use language that sounds technical and boring. They talk about accommodative monetary policy instead of saying we're printing money to hide insolvency. They talk about yield curve control instead of saying we're manipulating bond prices so the government can borrow for free. They talk about quantitative easing instead of saying we're creating currency out of nothing to buy assets and inflate prices. And they hide behind complexity. Most people hear the Bank of Japan is adjusting its yield curve control policy, and their eyes glaze over. It sounds like something only experts need to understand. But strip away the jargon and here's what it means in plain English. The central bank was forcing interest rates to stay low by printing money and buying unlimited amounts of bonds. Now they're stopping that, which means rates are going up, which means the free money party is over. The method they use to obscure this is even more insidious. They coordinate. When the Federal Reserve raises rates, but Japan keeps rates at zero, money flows from Japan to the US. That inflow of capital keeps US asset prices high, even though the Fed is supposedly tightening. It creates the illusion that the US economy is strong and resilient, when really it's just being propped up by borrowed yen. When Japan finally raises rates, that support disappears, and suddenly the foundation looks shaky. They also use the media to control the narrative. How many headlines did you see last week explaining the carry trade unwind in simple terms? Almost none. Instead, you saw markets volatile on mixed economic data or tech stocks pull back on profit taking. They describe the symptoms without explaining the disease. Because if regular people understood that global markets have been artificially inflated by central bank policy for 15 years and that policy is now reversing, there would be panic. And panic leads to selling, which leads to crashes, which exposes the whole game. But here's the emotional reframe you need to understand. You're not a victim in this. You're a player who didn't know the rules. And now that you know the rules, you can position yourself differently than the crowd. The crowd is going to panic sell when markets drop. You're going to understand that the drop is a mechanical unwind of leverage, not a reflection of underlying business value. The crowd is going to think the economy is collapsing. You're going to think borrowed money is leaving the system, which will create opportunities to buy assets at a discount. The crowd is going to trust that central banks will just cut rates again and fix everything. You're going to understand that central banks are trapped between inflation if they cut too soon and market collapse if they don't. Let me give you the first action step, something you can do today that almost nobody is talking about. Go into your brokerage account right now and look at the holdings in your index funds. I'm serious. Do this today. Most people own an S&P 500 fund or a total market fund, and they think they're diversified. But here's what you're going to find. The top 7 stocks in the S&P 500. Apple, Microsoft, Amazon, Google, Nvidia, Meta, Tesla. Depending on the day, those 7 stocks make up roughly 28 to 30% of the entire index. Think about that. You think you own 500 companies, but almost a third of your money is concentrated in 7. Now look at what those companies have in common. They've been massive beneficiaries of low interest rates and cheap capital. Tech companies grow by burning cash and borrowing cheaply to fund expansion. When rates are zero and money is flowing from Japan and elsewhere into US markets looking for returns, tech stocks go up regardless of profitability. But when that money flow reverses, when rates rise and leverage unwinds, those stocks get hit first and hardest. You saw this last week. The NASDAQ dropped significantly more than the Dow. Why? Because the NASDAQ is tech heavy and tech is leverage heavy. This isn't a coincidence, it's math. So here's what you do. Calculate how much of your portfolio is actually concentrated in those top 7 tech stocks. If it's over 25%, you're not diversified. You're making a leveraged bet on expensive growth stocks during a period when the cheap money that inflated them is disappearing. That doesn't mean sell everything in a panic. It means rebalance. Take some profits from your overweight tech positions and move them into sectors that benefit from higher rates or that are undervalued. Financials, for example, often do better when interest rates rise because banks make more money on the spread between what they pay depositors and what they charge borrowers. Energy, which has been hated for years, is trading at much lower valuations than tech. The second thing you need to do, and this is critical, is understand your own leverage. Do you have a home equity line of credit that you've tapped? Do you have margin in your brokerage account? Did you take out loans to invest, thinking rates would stay low forever? If yes, you need to reduce that leverage immediately. Not next month, now. Because when central banks tighten and carry trades unwind, liquidity disappears. That means if you need to sell something to pay a margin call or cover a loan, you might have to sell at the worst possible price because there aren't buyers. I'm going to tell you something that might make you uncomfortable, but it's true. The financial system is not designed to make you wealthy. It's designed to extract wealth from you through fees, through inflation, through information asymmetry. The reason they don't teach this stuff in schools is because an informed population is harder to control and harder to profit from. When Japan kept rates at zero for 15 years, who benefited? Hedge funds that could borrow for free, banks that could lend at higher rates, corporations that could borrow cheaply to buy back stock and inflate their share prices, which made executives rich through stock options. Who didn't benefit? Savers in Japan who got zero return on their deposits for a decade and a half, retirees who couldn't live off interest income, workers whose wages stagnated because the economy never actually recovered. It was just artificially propped up. And now, when Japan raises rates and the whole system starts to unwind, who's going to suffer? Regular investors who bought at the top, thinking the market only goes up. People with adjustable rate mortgages or variable rate loans who will see their payments increase. Workers who will lose jobs when over-leveraged companies start cutting costs. Who will survive and profit? The people who understand the game, who reduce leverage before the unwind, who have cash or stable income to buy assets when they're on sale. Let me take you deeper into the psychology here, because this is where most people get it wrong. There's this idea in finance called recency bias. It means we assume the recent past will continue into the future. If markets have gone up for 10 years, we assume they'll keep going up. If interest rates have been low for 15 years, we assume they'll stay low. This bias is why most people are terrible at timing. They buy at the top after years of gains because they finally feel safe, and they sell at the bottom after a crash because they can't imagine it recovering. Japan's zero rate policy created the mother of all recency biases. An entire generation of investors and traders have never operated in a normal interest rate environment. If you started your career in finance after 2008, you've only known zero rates, quantitative easing, central bank support. You've been trained to buy the dip because central banks always stepped in to support markets. You've been trained to borrow because money was free. You've been trained to ignore valuations because this time is different and tech is the future. But now the conditions are changing, and that training is going to destroy people. Buying the dip works when central banks are easing. It doesn't work when they're tightening and liquidity is leaving the system. Borrowing is smart when rates are zero. It's suicide when rates are rising and your collateral is dropping in value. Ignoring valuations is fine when there's infinite money chasing assets. It's catastrophic when money is scarce and people actually care about earnings and cash flow again. Here's a specific example of how this plays out. Let's say you're an investor who bought a tech stock at a price to earnings ratio of 50, meaning you paid $50 for every $1 of annual earnings. In a zero rate environment, that might make sense because there's nowhere else to get returns. Bonds pay nothing, savings accounts pay nothing, so you pay up for growth. But when rates rise to 4 or 5%, suddenly you can get a guaranteed 4 to 5% return in a treasury bond with zero risk. Why would you pay 50 times earnings for a risky tech stock when you can get 4 to 5% guaranteed? You wouldn't. So that tech stock needs to reprice. Maybe it goes from a PE of 50 to a PE of 25 or 30. That's a 50 to 40% price drop, not because the company got worse, but because the alternative investments got better. This is already happening. You're seeing it in real time. The stocks that got hit hardest last week were the ones trading at the highest valuations. The ones that held up better were value stocks, dividend payers, companies with actual cash flow and reasonable prices. Now let me tell you about another historical parallel that's going to blow your mind, because it shows this exact pattern on an even bigger scale. In the 1920s, the United States experienced a massive stock market boom. The Dow Jones went from around 60 points in 1921 to 381 points in 1929. That's more than a six-fold increase in 8 years. Everyone felt like a genius. People were borrowing money to buy stocks on margin, meaning they'd put down 10 or 20% and borrow the rest from their broker. As long as stocks kept going up, this worked beautifully. You could control $10,000 worth of stock with only $1,000 of your own money. If the stock went up 10%, you made $1,000 on a $1,000 investment. 100% return. But here's what nobody thought about. That leverage works both ways. If the stock drops 10%, you lose your entire $1,000. And if it drops more than that, you owe money you don't have. In October of 1929, the market started to fall. Not crash at first, just fall. But that fall triggered margin calls. Brokers demanded that investors either put up more cash or sell their stocks. Most people didn't have more cash, so they sold. That selling pushed prices lower, which triggered more margin calls, which caused more selling, which pushed prices even lower. It became a self-reinforcing spiral. By the end of it, the market had lost nearly 90% of its value over the next few years. People who had been millionaires on paper were bankrupt. Banks that had lent money for stock speculation failed. Life savings evaporated. And it wasn't because the underlying businesses all went bad simultaneously. It was because the leverage in the system unwound. And when leverage unwinds, it doesn't matter what the fundamental value is. Everything gets sold. That's the risk right now with the Japan carry trade. It's not that US companies are suddenly worthless. It's that trillions of dollars of borrowed yen need to get repaid. And that means selling assets regardless of value. When forced selling happens, prices disconnect from fundamentals. You get crashes that don't make logical sense until you understand the mechanics of deleveraging. Here's the part that should really concern you. The total size of the carry trade, money borrowed in yen to invest elsewhere, is estimated to be somewhere between $4 and $20 trillion, depending on who you ask and what you count. Nobody knows the exact number because a lot of it happens in shadow banking and offshore accounts. But even if we take the conservative estimate of $4 trillion, that's larger than the entire GDP of Germany. That's a massive amount of money that could be forced to liquidate if the yen keeps strengthening and Japanese rates keep rising. And here's the thing. Japan doesn't really have a choice about raising rates anymore. They're caught in their own trap. Inflation in Japan is rising for the first time in decades. It's not hyperinflation, but it's enough that the Bank of Japan can't justify zero rates anymore without looking completely incompetent. The yen had gotten so weak that imports were becoming painfully expensive. Japan imports most of its energy and food. When the yen is weak, those imports cost more, which drives up prices for Japanese consumers, which creates political pressure to do something. So they raise rates, knowing it would cause pain in global markets because the alternative, runaway inflation at home and a currency collapse, was worse. They chose the lesser of two evils from their perspective. But that choice just exported the crisis to everyone who borrowed yen cheaply for the last decade and a half. Now you might be thinking, okay, David, this sounds bad, but won't central banks just step in and fix it like they always do? Won't the Fed cut rates? Won't Japan reverse course? Won't somebody do something to stop the bleeding? Maybe. But here's the problem. The Fed is stuck between inflation and recession. If they cut rates too soon, inflation comes roaring back. We're still above their 2% target. If they wait too long to cut, the economy tips into recession and markets crash. They're trying to thread the needle, and historically, the Fed almost always fails at soft landings. They either tighten too much and cause a recession, or they ease too soon and let inflation run hot. Japan is stuck too. If they reverse course and drop rates back to zero, they lose all credibility, the yen collapses even further, and inflation accelerates. If they keep raising rates, they risk crashing their own stock market and economy, which is already barely growing. There's no good option. Every choice has painful consequences. This is what happens when you manipulate markets for too long. You create dependencies and imbalances that can't be unwound smoothly. It's like taking painkillers for years to avoid dealing with an injury. Eventually, the underlying problem gets so bad that when you stop the painkillers, the pain is unbearable. Central banks have been giving markets painkillers in the form of low rates and money printing for 15 years. Now they're trying to taper off, and the withdrawal symptoms are severe. So what do you actually do with this information? How do you position yourself when you understand the game, but you're not a billionaire with offshore accounts and teams of advisors? First, you accept that volatility is coming. Not maybe, it's already here. Markets are going to swing wildly as this carry trade unwind plays out. Some days will be up 3%. Some days will be down 4%. Your portfolio balance is going to move by thousands or tens of thousands of dollars in a single session. You need to prepare yourself psychologically for that, because if you're not prepared, you're going to make emotional decisions that lock in losses. Second, you build cash reserves. I know, cash feels like trash when inflation is running at 3 or 4%. You're losing purchasing power, just holding it. But cash is optionality. Cash is the ability to buy when assets are on sale. When everyone else is forced to sell because they're over-leveraged and getting margin calls, you want to be the person with dry powder ready to deploy. How much cash? Enough to cover 6 to 12 months of expenses if you lose your job. Plus enough to deploy into investments if we get a real correction. For most people, that's probably 20 to 40% of your investable assets in cash or very short-term treasury bills right now. Third, you reduce complexity in your portfolio. A lot of people have built these incredibly complicated portfolios with 12 different funds and crypto and options and individual stocks and alternative investments. Complexity feels sophisticated, but it's actually fragile. When markets get volatile, you want to know exactly what you own and why. You want positions you can explain in one sentence. I own this S&P 500 fund because I want broad exposure to US large caps. I own this treasury bond because I want safe income. If you can't explain a position simply, you probably don't understand the risk, and you should sell it. Fourth, and this is the one most people resist, you accept that you might miss some upside in exchange for avoiding catastrophic downside. Let's say markets rip higher from here, and you're sitting in 30% cash. You'll underperform. You'll feel stupid watching everyone else make money. But if markets crash 40% and you have cash to deploy at the bottom, you'll outperform massively over the next 5 to 10 years. The goal isn't to catch every move. The goal is to survive and compound over decades. You can't compound if you blow up. I want to give you one more historical example that really drives this home. And it's about the Nifty 50 stocks in the early 1970s. The Nifty 50 were the 50 stocks that everyone believed you could buy and hold forever. Companies like IBM, Polaroid, Xerox, Coca-Cola, McDonald's, these were the blue chip growth stocks of their era. The common wisdom was that you could pay any price for these stocks because they were such great companies that they'd always grow and always be worth it. Sound familiar? It's exactly what people said about tech stocks for the last decade. In 1972, these stocks were trading at price-to-earnings ratios of 50, 60, even 80 in some cases. People didn't care because the story was so compelling. Then the market crashed in 1973 and 74. The Nifty 50 got destroyed. Many of them fell 70, 80, 90%. Polaroid went from a PE ratio of over 90 to being a penny stock within a decade. It didn't matter that these were good companies. The valuations were insane. And when sentiment shifted, the bottom fell out. The investors who survived and thrived through that period weren't the ones who held on to Polaroid hoping it would come back. They were the ones who recognized the bubble, took profits or stayed in cash, and then bought great companies at reasonable prices after the crash. Warren Buffett barely invested at all in the late 60s and early 70s because he thought everything was overpriced. People called him washed up and out of touch. Then the crash happened, and he had cash to deploy when assets were cheap. He came out of that period wealthier and with a better portfolio than almost anyone. That's the playbook right now. You're not trying to be a hero and catch the exact top or bottom. You're trying to be rational when everyone else is euphoric or panicking. You're trying to understand the mechanics, the leverage, the forced flows of capital, so you can position yourself on the right side of the trade. Let me be very clear about something. I'm not saying sell everything and hide in a bunker. I'm saying understand what you own and why, reduce leverage, build cash, and be prepared for volatility that most people aren't expecting. Because most people still think central banks have everything under control. They think this is just another dip to buy. They think Japan raising rates by a quarter point is irrelevant. But you now understand that it's not irrelevant. It's the trigger that started unwinding one of the largest carry trades in financial history. And that unwind is going to ripple through every market, every asset class, every currency, because the whole global system has become interconnected and dependent on cheap money. Think about what happened in 2008. The housing crisis started in subprime mortgages in the United States. Most people thought it was contained, just a problem for people who bought houses they couldn't afford. Then Lehman Brothers collapsed, and suddenly the entire global financial system was on the brink. Why? Because those subprime mortgages had been packaged into securities and sold to banks and pension funds and hedge funds all over the world. The leverage and interconnection meant that a problem in one small corner of the market spread everywhere. This is the same thing, just a different corner. The corner is the Japan carry trade. The leverage is trillions of dollars borrowed at near zero rates. The interconnection is that money spread across global equities, bonds, real estate, everything. When it unwinds, it's not just a Japan problem. It's everyone's problem. And the psychology of it is what's going to determine whether you come out ahead or behind. Most people are going to react emotionally. They're going to panic sell at the bottom. Or they're going to hold on to losing positions out of stubbornness and hope. Or they're going to double down trying to catch a falling knife. All of those reactions come from not understanding the underlying mechanics. But you're different now. You understand that this isn't about whether companies are good or bad. It's about forced deleveraging. You understand that central banks created this situation by keeping rates too low for too long. And now they're trapped trying to normalize without crashing everything. You understand that the crowd is always wrong at turning points because the crowd operates on emotion and recency bias. So when your neighbor tells you he's buying the dip because stocks always come back, you'll smile and nod and quietly be grateful you're not following that advice blindly. When the talking heads on financial television say this is a buying opportunity, you'll remember that their job is to keep you engaged and trading, not to make you wealthy. When your financial advisor tells you to stay the course and think long-term, you'll ask them specifically how much of your portfolio is concentrated in over-leveraged, overvalued growth stocks that benefited from the carry trade, and you'll watch them fumble for an answer. The game is rigged, but it's not rigged in a way that you can't win. It's rigged in a way that requires you to understand the rules and play differently than the majority. The majority is going to get slaughtered in this unwind because they don't understand what's happening. They think it's random volatility or just a temporary correction. You know better. You know that Japan just pulled the trigger on a mechanism that's been building pressure for 15 years. You know that trillions of dollars of leverage are unwinding. You know that central banks are trapped between bad options and worse options. And you know that this creates both massive risk and massive opportunity depending on how you're positioned. So here's what I want you to do right now, today, before this video ends and you forget and go back to your normal routine. Open your brokerage account. Look at your actual holdings, not what you think you own, but what you actually own. Calculate your concentration in the top 7 tech stocks. Calculate how much leverage you have, margin, home equity lines, any debt used to invest. Write down those numbers. Then ask yourself honestly, if markets drop 40% over the next year, Will I be okay? Will I have enough cash to live? Will I be forced to sell at a loss? If the answer to any of those questions makes you uncomfortable, you know what you need to do. Reduce concentration, reduce leverage, build cash. It's not sexy. It's not going to make you rich overnight, but it's going to keep you in the game so that when this unwind plays out and assets are actually cheap, you have the resources and the psychological stability to buy. That's how you build real wealth. Not by chasing the hot stock or the clever trade, by understanding the macro forces, positioning yourself conservatively when everyone else is euphoric, and then being aggressive when everyone else is hiding in fear. It's the same playbook that's worked for every successful investor in history. And it's going to work now, but only if you actually do it, instead of just